Let's be honest. When people hear high interest rates, it sounds like one of those boring economic phrases that should only matter to central bankers, CNBC anchors, and that one guy who says macro environment at parties. But in real life, high interest rates are not some abstract policy debate. They are the reason your mortgage looks terrifying, your car payment feels insulting, your credit card balance behaves like it's training for the Olympics. And even people with decent incomes still walk around saying, "How am I making this much and still feeling broke?" That's the story. High interest rates are supposed to cool inflation, and sometimes they do. But while they're busy fixing the economy, they also make normal financial life dramatically harder. They hit buyers, renters, businesses, workers, investors, and governments. Basically, if you participate in the economy in any way, which, rude as it sounds, you probably do, then high rates are affecting you. So why does this happen? Why do high interest rates seem to hurt almost everyone? Let's break it down. 1. They make borrowing painfully expensive. This is the most obvious effect, and it's also the one people feel first. When rates go up, borrowing money gets more expensive. Mortgages, car loans, personal loans, business loans, and especially credit cards all become more painful. Housing is the clearest example. Even if home prices stop rising, higher mortgage rates can still make the monthly payment explode. So buyers don't just face expensive homes, they face expensive financing too. It's like finding out the concert ticket is overpriced, then discovering the service fee has started its own criminal enterprise. Car loans work the same way. The car may be the same, but the monthly payment suddenly feels like the vehicle should come with a private driver and a complimentary therapist. And for people carrying credit card debt, high rates are even worse. Interest starts piling up fast. What looked manageable can become sticky debt that refuses to die. That's why high rates feel so brutal. They don't just raise the cost of luxury, they raise the cost of normal life. 2. They crush affordability, even when prices don't move much. This is where people get confused. They think, okay, inflation is slowing, so why does everything still feel impossible? Because affordability is not just about price, it's about payment. A house doesn't need to get more expensive to become less affordable. The monthly payment can do all the damage. Same with a car. Same with business borrowing. Same with almost anything that involves financing. That's why so many people feel like the math of life has changed. On paper, they may still have a decent salary, but in practice, higher rates make every major purchase heavier. The result is a weird kind of financial claustrophobia. You're not broke in the dramatic movie sense. You're just trapped in a world where every decision costs more than it used to. And that matters because affordability shapes behavior. People delay buying homes. They postpone replacing cars. They stop taking chances. They become more cautious, not because they're irrational, but because the numbers stop being friendly. 3. They freeze the housing market and make everyone miserable in different ways. High rates don't just hurt homebuyers, they mess up the entire housing market. Buyers get squeezed because mortgages are expensive, but existing homeowners also get stuck, especially people who locked in very low mortgage rates a few years ago. If they sell, they may have to trade their cheap mortgage for a much more expensive one, so they stay put. That means fewer homes hit the market. Fewer homes means tighter supply. Tighter supply means home prices often stay more stubborn than buyers hoped. So now you have a market where buyers can't buy, sellers don't want to sell, and everyone acts like a two-bedroom house built in 1987 is a luxury artifact. And renters don't exactly get a happy ending either. When people can't buy, they stay in the rental market longer. More rental demand can keep rents high. So even if you never plan to buy a house, high interest rates can still hit you through housing costs. That's what makes the whole thing so frustrating. High rates were supposed to cool the housing market, but instead, they often create a kind of frozen mess where nobody feels like they're winning. 4. They squeeze businesses, and then businesses squeeze everyone else. When interest rates rise, businesses get hit too. Small businesses especially rely on borrowing to expand, hire, buy equipment, or survive rough patches. When loans become more expensive, growth plans get delayed. Hiring slows down. Expansion gets shelved. Everyone becomes cautious. Big companies feel it too. Higher financing costs can reduce profits, make future projects less attractive, and force executives into what they love calling discipline, which usually means spending less and expecting employees to smile through it. And when businesses get squeezed, they pass that pressure on. They raise prices where they can. They cut costs where they can. They slow hiring. They become conservative, which means consumers pay more, workers feel less secure, and the entire economy starts losing momentum. This is one of the hidden reasons high rates hurt so much. They don't just make money expensive, they make optimism expensive. Suddenly, every business decision has to survive a much harsher math test. 5. They weaken the job market sometimes without mass layoffs. People often think a bad labor market only matters if unemployment spikes. But high rates can make workers feel worse long before layoffs become dramatic. When businesses borrow less and spend less, they also hire less. Maybe they freeze hiring. Maybe they cut overtime. Maybe they quietly remove job postings and start using words like efficiency and streamlining, which is corporate language for "we're about to make this everybody's problem." Even if you keep your job, a weaker job market changes your behavior. You may feel less confident asking for a raise, less willing to switch companies, less comfortable making big purchases, less certain about the future. That anxiety matters because economies don't run only on money, they run on confidence. If millions of people become just a little more nervous at the same time, spending slows, risk-taking fades, and the whole system gets more fragile. That's why high interest rates can make people feel poorer without actually cutting their paycheck. They make the future feel less secure, and insecurity is its own kind of financial pressure. 6. They pressure investments, retirement accounts, and even governments. A lot of people hear that higher rates are good for savers, and sure, that's true in a narrow sense. Cash can finally earn something, but the bigger picture is messier. Higher rates can pressure stocks, especially expensive growth stocks, because when safer returns go up, investors become less willing to pay huge prices for future profits. Real estate also feels the pressure. So while your savings account may look slightly more respectable, your retirement portfolio may start acting like it needs a nap and a support group. And it doesn't stop there. Governments borrow money too, and when rates stay high, servicing that debt gets more expensive. That can mean more budget pressure, more political fights, and less room for spending on things people actually need. So yes, some savers benefit, but that doesn't mean the average person feels better off. If your mortgage is worse, your rent is still high, your job feels less secure, and your investments are wobbling, earning a little more on cash may feel less like victory and more like a coupon for a store that's already on fire. So why do central banks raise rates at all? Because inflation is also terrible. That's the uncomfortable part. High interest rates are painful, but runaway inflation can be even worse. If prices keep rising too fast, wages struggle to keep up, savings lose value, planning gets harder, and the economy becomes unstable in a different way. So central banks raise rates to slow demand. The goal is to cool things down before inflation becomes even more destructive. In other words, this is not random cruelty. It's policy medicine. The problem is, medicine can still have side effects, and right now, those side effects are everywhere. The bottom line. So why are high interest rates hurting everyone? Because they make borrowing more expensive, destroy affordability, freeze housing, squeeze businesses, weaken confidence, pressure jobs, hit investments, and strain governments. They don't just target excess demand in some clean theoretical sense. They hit the real systems people use to live, work, move, build, and plan their lives. That's why so many people feel stuck right now. Not because they're bad with money, not because they missed some genius investing hack, but because when money itself becomes more expensive, it quietly makes almost everything else harder too. And that may be the most frustrating part of all. High rates can be necessary. They can help fight inflation. They can even restore balance over time. But in the short run, they make everyday life feel heavier, tighter, and much less forgiving. So if the economy feels weird right now, that's because it is. We're living in a world where the cure for one financial problem creates a whole new set of others. And that's the reality of high interest rates. They may be trying to fix the system, but in the meantime, they're putting nearly everyone on a stricter budget, whether they signed up for it or not.